Hello, can you go? Hello, can you go? Fixed rates are cheaper than variable rate home loans right now, so is lower better? Fixing your rate can have some pretty big consequences. So in this video, I'm gonna take you through the 5 things you need to ask yourself before you fix your home loan. So if you're thinking about locking in for a cheap $199 fixed rate, then you're gonna wanna watch this video. Let's dive right in. Hello, can you go? Hello, can you go? The banks have recently come out and offered some astoundingly cheap 2, 3, and 4-year fixed rates. And it might seem like an easy decision. Why not lock in your fixed rate if it's 0.5% cheaper than the variable rate? And that's where most people make the mistake. Before you fix, you need to ask yourself these 5 questions. But before we get into those, remember to like and subscribe. If you like this video, leave a thumbs up below. Number 1, is there a chance you might sell the property during the fixed rate term? Now, fixed rates are a little bit like mobile phone contracts. If you're fixed for say 4 years, if after say 2 years you want to sell and get rid of the property, the banks can charge fixed rate costs for years 3 and 4 that you're not still in the loan. Now, it's pretty hard to know today definitively what you're going to be doing in the next 4 years, but it's worth trying to ask yourself a couple of these questions. I've made this mistake myself before. Even if you're not sure you're going to be selling a property in the next 1 to say 5 years, a couple of questions you want to ask yourself are: 1, do you think it's likely you're going to get married in the next 1 to 5 years? I found after I got married, your priorities change a little bit, and you go from being a couple, having friends over and entertaining, to being a couple with a couple of kids on the way. Which gets me to the next question you want to ask yourself. Although you might not be sure if you're going to sell the property in the next few years, are you likely to have kids? And is that property going to be big enough to accommodate 2 or 3 or 4, or however many kids you're going to have in the next little bit? Is there a chance you're going to change jobs in the next 1 to 5 years? And 4, is it possible for you to move cities or go on an extended holiday? Again, you might not be intending on selling your property, but if there's any of these big life changes in the next little while, it may change your position, and having a fixed rate could lock you in for some pretty horrendous costs that you're going to have to pay down the line to break that fixed rate. For me personally, 5 years ago, I just got married. It was actually my 5th wedding anniversary last month. And at the time, we were just thinking about getting married, going on a honeymoon, and kids were a bit of an idea, but nothing really formalized. Fast forward to today, and I've got 2 kids and our house is way too small. So like I mentioned, although you might not be intending on selling the property in the next sort of 1 to 5 years, it's worth thinking about, are there going to be any changes in your personal situation, your relationship, work, or anything that might mean you're gonna have to sell or upgrade or downgrade that home you're moving into today. As a side note, how much does it cost to break a fixed rate loan? This is something we get asked all the time, and it really depends on the direction of the market. So let's say, for example, you fixed at 2%. If the rates go up in the future and the rates are actually higher in the future, there won't be any break costs because the bank's not technically losing money because your rate's at 2% and the rates in the future might be 5%. But if the rates go down from 2% to 1%, and the bank's losing 1% of money, then that's how much they charge you in break costs. It gets pretty complicated, but it's something worth considering. Number 2, is it likely you're gonna need to increase your loan or withdraw equity from the property in the next 1 to 5 years? If the lender that you get your loan from today isn't flexible with doing equity increases or refinancing, you could find it to be pretty costly to try and move or change banks while you're in that fixed rate period. Now, a good example of this is ING Bank. Say you might go to ING today, have a 4-year fixed rate, and be like, I'm sweet, everything's good, we're not gonna have kids, and it's all good. Fast forward to 2 years' time, you might be thinking about doing, say, a construction loan, doing some renovations on the home, and completely overhauling your house. Now, based on ING's policy today, they don't allow construction loans, so you'd actually have to look at moving banks to be able to get those renovations and those extra rooms added on for the kids or whatever life might throw at you in the next few years. So again, if the plan is to renovate the property during the fixed rate period, then it might be worth considering just leaving it as variable to give you that flexibility in case something changes in your situation. 3, are you planning on buying an investment property or using the equity in your home towards an investment? An equity release is when you basically get your home revalued. Say if you paid $500, it goes up to $600,000 and you borrow the difference. So you might borrow against that $100,000 in increased value. Now, the trouble with this is if you fix in with a bank, you are stuck with that bank for the next 1 to 4, maybe 5 years while the fixed rate's in effect. And if you're forced to break the fixed rates and move to a friendlier lender, there can be issues. Now, the most common issue we see here is a bad bank valuation. So as you can see on the example on the screen, we had a situation recently where one bank valued our client's property at $640, a second bank valued their property at $640, and a third bank valued their property at $770. That's a $130,000 difference. So again, being locked into a bank, if you're considering tapping on that equity, could lead you to troubles down the line. Because if you banked with Bank One and they valued your property at $640,000, it doesn't matter how much you try and debate and contest the valuations, it's very rare for them to change and increase the valuation in line with bank number 3. So you're only going to really have two options, either pay the break fees and move to Bank 3, or stick around with Bank One until the end of the fixed rate period and just suck it up. Question number 4, are you planning on making any extra payments during the fixed rate period? Most lenders offer fixed rate home loans that have a limited amount you can make in extra payments every year. This amount generally ranges from between $5,000 to $10,000 a year in extra payments on top of your minimum repayments. Now the catch here is once you go over that extra amount, so once you've paid an extra $5,000 or $10,000 in that year, the bank can penalize you and actually charge fixed rate break costs for paying too much back on the loan. And this is the downside with fixed rates. It's going to remove the flexibility of you being able to make extra payments if you fix the whole loan. So obviously there's a couple of ways around. You can do a bit fixed, a bit variable to take advantage of that. But the questions I'd be asking myself if I was wanting to make extra payments and if I was really thinking about fixing my rate would be, do you think your income's going to increase over the next 1 to 5 years? You might be only able to afford, say, the minimum or close to the minimum repayments today, but what happens if your income increases or you get paid a bonus or a tax refund and you want to lump down that loan quicker? 2, do you think you will receive any bonuses, inheritances, or large chunks of income that are going to help you with paying down that loan? 3, do you think you're going to be in a position to make more than $200 a week in extra payments to that loan? Because $200 a week roughly works out to be $10,000 a year, and that's generally where the banks tap out. If you answer yes to one of these questions, then 100% fixed rate may not be a good option. Like I said, the alternates are keep some fixed, some variable, so you've got best of both worlds, or just stick with the variable rate in the short term. The good thing is you can always change from variable to fixed at any time. You just can't go back from fixed to variable. Kind of sucks. Number 5, do you want to use your home loan as a savings account and access redraw? Redraw is just the ability to transfer back any extra repayments you've made. So if you made an extra $200 a week in repayments, you can transfer that back out as redraw because your loan is ahead. Now the downside with fixed rates with the majority of lenders is they don't allow redraw on a fixed rate. So you could make that extra $200 in repayments to a fixed rate. If you need to redraw it back in an emergency, it's stuck until the end of the fixed rate period. Realistically, the fixed rate here removes the flexibility from being able to access those funds, and if an emergency comes up, you could be stuck. You definitely want to have some buffer money there, so just keep that in mind if you are looking at fixing 100% of the loan. Listen, overall, fixed rates are a great tool. I don't want to be too negative on them. They can be really handy for helping you budget. They can give you some stability. At least you know, all right, for the next 4 years or whatever it's going to be, my repayment's going to be set. But there are some negatives with the extra payments. And like I said, if you're looking at making changes to your situation, if you might have kids in the next little while and have to upgrade your home, it can shoehorn you a little bit and get you stuck. If you're not sure what to do, hit us up. We're mortgage brokers based in Brisbane, but help clients from all around Australia. If you want to get in touch, hit us up at huntergalloway.com.au.